Good day, it's Christine Hughes here from Ottawa Capital Management, President and Chief Investment Officer. I'm here to talk to you about Japanese radical monetary policy and why we believe that it marks the beginning of the end of the Japanese bond market. So what have they announced? The details, this 2-2-2-2 policy. So basically they're going to create, out of thin air, 2% inflation, and remember for the past 2 decades all they've seen is deflation. So they're going to have 2% inflation in 2 years' time. They're going to do that by doubling the monetary base in the next 2 years. So doubling the amount of money in circulation in the next 2 years, which is very radical. It's very extreme. We haven't seen this before. Remember, the way things go in economics is the more you have of something, the less it's worth. You double the supply of anything out there, the price of it is going to go down. And that's exactly what they're trying to do. A weaker currency, a weaker yen, creates inflation because what it can buy goes up in value. So what they're doing is about $72 billion a month of new money being created out of thin air, and that's comparable to the US's $85 billion a month. However, the difference is Japan is 1/3 the size of the economy. So why does this matter? I get pushback all the time of, why does this matter? All of their bonds are owned internally. Who cares? They can have a debt default and it won't really matter. Well, you can see on this slide that their bond market is the second largest bond market in the world by a mile. The only bond market, sovereign bond market, that's bigger than theirs is the US's. And again, the US economy is 3 times the size of Japan's. The next guy down is Italy, and it's only about $2 trillion. Japan has about $10 trillion US dollars worth of debt outstanding. 90% of it's domestically held, so that part is true. But this massive amount of debt is why this issue matters, why you must understand what they're doing and the implications and the risks. This will not remain a domestic issue. When time comes that these bonds are at risk, that money is going to flee. 60% of this gargantuan mound of debt comes due in the next 5 years. So they have to roll it over the next 5 years. Just remember, Greece, tiny little bond market, it's not even on that chart, it's so small. And the implications we felt from that last year, this is Japan and its serious size, it's going to matter. So who hold these bonds? Yes, domestic, but even inside the domestics, it's these insurance type, kind of sleepy companies. This is how individuals own the bonds through these companies, postal and savings. But you can see here in this chart that they don't own a lot of other things. It's massively overweight domestic bonds, domestic government bonds. And the US, Japan is just following the leader in quantitative easing. The United States have announced last fall their own very aggressive policy of $85 billion a month that is unending. There's no end in sight for that. It's unlimited. But the equivalent of what Shinzo Abe, the Prime Minister of Japan, has announced is almost about $230 billion equivalent. If their countries were the same size, $230 billion a month. So very extreme, but it's not like they're the only ones doing it. You can see the party is just getting started. For a lot of them, it got started in 2008. So a big jump up, and they've all been adding, with respect, maybe with exception to the European Central Bank of England. But you see the bottom line, the Bank of Japan, this thing is set to accelerate greatly. So, it's keeping up with the total amount, but again, it's a much smaller economy. So that's the backdrop. That's kind of what they've announced, the size of it, puts it in perspective. What we're seeing right now, the impact of it on markets is this weak yen that they're trying to achieve, this trashing of their own currency, is working, and it's all good. Everybody's happy, things are going up, weak yen is a good thing. So we see on the slide here this massive run up in the Japanese stock exchange, the Nikkei. It's up 50% in the last 6 months, because the currency, the blue line, is actually down. It's the inverse on this chart. It's down 25% over the last 4 months. Really big moves, but it's in the right direction for stocks. Everybody's happy. Hooray, so weak yen is good. A lot of people are flooding into that stock market because positive returns, everybody follows. So look at the jump in flows into stock markets. And these are domestic mutual funds, domestic investment funds. It's not really those big pension funds we saw earlier. It's just a lot of smaller accounts. Mutual fund industry in Japan is still large, but it's a lot of faster money than the big slow behemoths. It's also everybody else front running what those pensions are going to do, because they are slow moving. So let's take a look at how you do that and what that is. It's called the yen carry trade. So all you need to know about that is interest rates in Japan are really, really low. I know they're low everywhere, but they're absurdly low in Japan, considering the amount of debt they have, especially. But you can see the red line here is their interest rates on their bonds at every interval, all the way out to 30 years. So these are, upward sloping yield curves. That's the proper way they should be structured, but it goes from 0.1% all the way up to a shocking 1.6% 30 years out. So extreme low rates, especially in the short end, 6-month, 1 year, 2 year, 3 year, 4 year bonds. It's compared to the US. So what happens is companies, funds, investment funds, pension funds all over the world come and borrow in yen, pay those paltry interest rates, and then go invest elsewhere in yield products, and they make the difference. And the only way you would do that, the only way you embark on a carry trade like that, is if you have the back of the central bank. So the central bank has committed to destroying that currency, because then you're actually going to pay down your loan in a cheaper currency. So once Japanese government announced that they're going to embark on this controlled destruction of their currency, everybody got on board. You borrow in yen because the currency is going to go down, and then you go invest elsewhere where the currency will go up, and you make that interest rate spread. That's called the yen carry trade. And you lever it up 10 to 1, 20 to 1, 30 to 1. And so the impact of their spending on their bond buying program and how much they're increasing their money supply each month is augmented many, many times over by this yen carry trade. You see here on this slide, lots more people joining the party. Everybody's happy. These REITs, Japanese real estate trusts that the government is also buying. They're not just buying their own bonds, they're buying these things. Lots of people front running there. You borrow in yen and you can actually invest in the REITs. These are up 100% in 4 months. So this has been very radical. It has had a very dramatic impact on global REITs around the world, because people will arbitrage the difference. They'll buy them and buy the others and equalize. So it's had a profound impact on real estate globally. And of course, we have the quintessential unintended consequences of any time governments get in and meddle with free-floating capital markets. This slide is the 10-year government bond yield. So the interest rate on the 10-year government bond in the United States since the crash in 2008. And I've highlighted here the QE programs that they embarked on. And you can see while the program was actually in action, so they were actually printing the money, interest rates went up. And so the first QE, it went up, interest rates went up 90%. Then the next QE, they went up 55%. It's not until the program rolled off that yields fell. So during the program, interest rates went up. Well, this QE program now that they were doing in the United States is as large as the first time. So you could maybe expect almost as big a rise, but it's been capped. You can see it only got up over 20%, and then Japan came in and announced theirs, and it capped interest rates and actually has pressed yields lower. Despite the fact the United States is buying $85 billion a month, Japan is actually trumping what they're doing, and it's creating this yen carry trade. They'll borrow in Japan, pay 0.4%, and then buy U.S. Treasury at 1.7% and make the difference, lever it up, and they'll do that all day long. They'll go up. The effect of this is interest rates go down, so the bond prices go up, but also bond equities go up. So again, weak yen is good. Everybody's happy because everything's going up. You flip over to Europe, same thing. Italian yields, Spanish yields, even other emerging market yields are going down. The bond markets are going up. This slide here happens to be the Italian yields, and this is exactly what they're doing again. They borrow yen at 0.4%, and then, because they know that's going down, and then they buy the Italian bonds at 4%. That's a massive pickup, and they'll lever that up. And you can see how the initial program that the Japanese government does gets augmented in the system through leverage. So we've talked about how it's this very aggressive policy by Japan. I would call it insane. Policy by Japan has impacted yield instruments globally. They have worked to suppress yields globally since the end of last year, and very, very accelerated that during the month of April in 2013. But it has also hit other things that don't yield, things that have zero yield, and one of those things is gold. Here's the chart where I've identified where the U.S. announced their program. And similar to what happened with U.S. rates has happened to gold. Traditionally, through all the QEs of the United States have done, it's been good for gold. It's inflationary, it's the world's reserve currency, it's denominated in that currency, it's growth, it's whatever it is, the QE program, gold goes up because the unit of measure goes down. Well, in comes Japan and puts a cap on that. So you can see right after QE was announced early last fall, the Abe commentary, so Shinzo Abe's commentary kicked up. And as soon as he was perceived as a front runner in their elections and then was indeed elected at the end of the year, gold continued to be sold. Gold continued to be sold, which is very, very different from all the other times we had a very large program that the U.S. had embarked on. And then we had the Kuroda speech. Mr. Kuroda is the chairman of the Japanese Central Government Bank. That is the day he actually announced what the program is and just how big it is. It was monstrously big, bigger than anyone ever thought. And shortly thereafter, within 4 days, gold got trounced. And you can see the correlation. Gold does not yield anything. And so this, as interest rates fall lower and lower, the need and search, the thirst for yield becomes more and more insatiable. So, you know, it's had a profound impact on the gold market. People know me know I'm a big believer in gold because it is the anti-trade to all this money printing. But I think gold stays weak as long as this whole weak yen is good. So weak yen means things go up. Weak yen means you do your carry trade and you buy other bonds. Weak yen means suppression of yields everywhere. Gold has no yield. I think it remains under pressure until weak yen is a bad thing. I think we get there, but until that time, I think we see pressure on gold. So when is weak yen going to be bad? If everybody's so happy about you know, this weak yen, hooray, everything's going up, bonds are going up, stocks are going up, how does it turn bad, and why would it turn bad? Well, we agree with Soros. George Soros is he's an old dude. He's been around for decades. He's worth 20 billion bucks, trading his own investment firms, foreign exchange markets, and he basically has put a warning out for Japan and said what they're doing is actually very dangerous, and I would completely concur. It's because they may not be able to control the weakness at some point, and particularly it's because it's coming on the heels of 20 years of deflation. Let's flip over to the fundamentals of Japan, and we can see here in this chart the orange line is going up a lot. It actually doubles in value between now and 40 years from now. It's the number of people who are going to become dependent. So the old, the aged. It is a very lopsided demographics. Basically Japan, they don't let newcomers inside. They don't like non-Japanese people living in Japan. There's only a very small fraction of their community who are non-Japanese. So it just means that newcomers can't displace retiring people as a tax base. So you have people who have been supporting the bond market by giving their money to the postals and savings institutions who then go buy the government bonds. They're actually withdrawing their money. And that actually started last year, and it's a very profound thing. So this chart, there's an earlier chart that showed the beginning of this. This chart just shows the leverage in Japan relative to everybody else, but also relative to the size of the economy. So you can see it's very extreme. And this bubble is actually out of date by a few months. They're actually going to be at 245% of debt to GDP by the end of this year. And this is with very aggressive fiscal policy and the promise that they'll even do more if necessary. So very, very extreme leverage. So more math. This is how much money the Japanese spend on debt service. So out of all their tax revenues, that's the main revenue a country has, almost 60% is on just paying back the debt and interest. And almost 30% is only interest, and you can see it picking up. So it's a very dire situation just to begin with. And then you get this situation where more and more people are actually going to be needing services. If you look on this slide, this is the number of total expenditures that we're looking at, and they keep creeping up because the economy and the population base is aging, Social Security, etc. But also the revenue is doing nothing, the tax revenue is doing nothing but going down for the past 20 years. So fundamentally, the income statement is very, very poor and looking more so. This slide is the key one. This is on the Japanese Ministry of Finance website. Go look at it yourself. But this is the thing you need to understand. And this is why I feel so sure that this is going to be a big problem for the world. Whether or not the current Japanese government embarked on this program, it doesn't really matter. They were toast to begin with. You look at this black line. That's the amount of money they're spending on interest payments. Okay, that is going up, and it's accelerating just in the past 2 years. Look at the pink line. This pink line is the interest rate they realize on their debt. It keeps dropping. It's been dropping for 25 years. It drops and drops and drops, and yet now interest payments are accelerating to the upside. This is the wealthy barber in reverse, compounded interest working against you. So it doesn't really matter if they grow now or they stop generating these record deficits or they print money to buy. It doesn't matter. This thing's accelerating, and it's going to get out of control no matter what they do. What they're doing is actually pushing interest rates up by introducing inflation. If it works, that's going to bring forward the day of reckoning. It's not going to change anything. So this is why we're doing the video right now, because they've brought forward their own day of reckoning. So we say be careful what you wish for. This is the Japanese yield curve, so the interest rate on Japanese government bonds all the way out the curve. The light green line is before they announced it, this big program in April, and the darker green line is now. So you've seen already an updraft in interest rates, and it's small. The bar chart on the bottom just shows you the 5-year bond is up 12 basis points. I mean, 12 basis points doesn't seem much, but actually when you're starting off with almost nothing, it actually is a large percentage return. So interest, this is the key. Interest rates only have to go to 2.8% for 100% of their tax revenues to be going towards interest payments. So the bond market's not going to wait to that day. It's going to react way, way before. You're going in the wrong direction. You institute this program, you're introducing inflation, interest rates gets biased higher, and then you sink your actual income statement, your national accounts. So again, we're seeing extreme moves. This is again the Nikkei up 50% in 6 months. The stock markets can be volatile. The Japanese stock market definitely can be more volatile than the others, but 50% in 6 months is extreme. It's very, very aggressive move. You only saw that one other time in 1953, and right after that we saw an updraft of inflation at 10% per year. So like a massive move in inflation because of that. Also in their bond market, this chart just shows you an intraday move versus all the other intraday moves in the prior 3 years. Massive volatility introduced in the bond market. Again, people are going to want higher rates to account for this higher volatility, and we've seen them. So who's going to sell all these bonds? Well, we touched upon it earlier. This is the reproduction of that slide. This is the seller. These are the people that Soros was talking about, and that I think will be the sellers that will create that incredible currency weakness, a currency crash. The offshoot is hyperinflation within their domestic economy. It is a massive, very, very dangerous situation globally, and it's one that is going to happen anyways, but they just brought it forward. Again, what will this happen to, what will that mean for us in the United States, Canada, North America, globally, is rates. Rates will continue to go lower. And even when things turn bad, in the safe countries like North America, Canada, we have AAA rated bonds in our government's, federal government side. I think we see interest rates get driven down to the floor and then through. So realizing an actual negative interest rate on our bonds. It's not unheard of. We've seen it in Europe last year. I think you can easily see it here. So, you know, as you can see, the math is stacked against Japan. It's not a matter of if, it's a matter of when. This policy, all it has done is brought that day of reckoning, chaos, default forward. So just to sum up, we at Otterwood Capital, we're macro advisors. We study the macroeconomy. Capital preservation is paramount. Although we run yield-focused funds, the preservation of this capital is paramount. We have a very long history of doing just that. We do think Japan is going to be a crisis in the not too distant future, and our portfolios will be protected against that inevitability. Please follow us on Twitter at OtterwoodCapM. You would like to follow up videos to this one on Japan. We also do a quarterly update. Please contact your advisor, or you can contact us at info@otterwoodcapital.com. Thank you very much.